Hello to all my new investors. Today, let's talk about ETFs and what they really are. Have you ever asked yourself, what is an ETF? An ETF, or Exchange Traded Fund, is a fund that tracks an index like the NASDAQ 100 or S&P 500. When you buy shares of an ETF, you're buying a portfolio that mirrors the index's returns. Unlike other funds, ETFs don't try to beat the market. They simply replicate the performance of their native index. In other words, ETFs try to be the market itself. ETFs bundle together all the securities in an index. They don't track actively managed mutual funds because those disclose holdings infrequently. This makes ETFs transparent and easy to follow. You can trade ETFs like stocks throughout the day. Their prices fluctuate constantly, and you need a broker to buy or sell them. This flexibility is a big difference from mutual funds. ETFs are more tax efficient than mutual funds. They also have low operating and transaction costs. Plus, there are no sales loads or minimum investments required. ETFs have been around since the early 1980s. But gained popularity in the last decade. The most famous ETF is the SPDR, launched in 1993 to track the S&P 500. It made tracking the market easier for investors. Let's compare ETFs, mutual funds, and index funds. Mutual funds are actively managed by professionals aiming to beat the market, often charging higher fees. Index funds, like Vanguard's 500 Index Fund, launched in 1976, track markets passively at low cost. ETFs are a type of index fund, with the added benefit of trading like stocks. Many ETFs trade commission-free today, making them cost-effective. However, not all ETFs are designed to mimic indexes, so choose wisely. To sum up, ETFs offer investors a flexible, low-cost way to track market indexes. They combine features of stocks and index funds for broad market exposure. That's the educational overview of ETFs for today.